If you live in one of these 7 states, your taxes could be about to explode, not because of some distant national debt crisis, but because of what's already happening inside your state's budget right now. Most people assume a financial crisis hits the entire country at once, like one giant wave. It doesn't. It starts locally. It starts with your state, quietly, in ways most people ignore until it becomes impossible to deny. It shows up when pension systems quietly admit they can't keep their promises without major sacrifices. It shows up when local banks tighten credit because they know something is shifting beneath the surface. This is not a dramatic metaphor. This is solvency risk, the kind where the arithmetic simply stops working. Right now, the warning signs are not hidden. They're stacking up. Commercial real estate weakness is spreading. Billions in large loan maturities are coming due. Pension systems in multiple states are deeply underfunded. And state budgets are exposed. Because a recession does what it always does. It cuts revenue fast. So in this countdown, we're examining 7 U.S. states that are positioned to break first if the next economic downturn hits hard. Not because of speculation, because of the numbers, the structure, and the pressure points. If you want analysis that helps you protect your household before the headline shows up on national news, subscribe now. Because once a fiscal crisis becomes obvious, most options disappear fast. Let's start the countdown. Number 7. New Jersey. New Jersey is already experiencing financial pressure, with high costs, large obligations, and limited flexibility. Its pension system is significantly underfunded, creating a long-term burden on state finances. Unlike other states, New Jersey has little room left to raise taxes, making the situation more challenging. Property taxes, already among the highest in the U.S., continue to rise. These taxes fund not only schools and infrastructure, but also pension obligations and debt. As these costs grow, so does the burden on residents. This creates a dangerous cycle. High taxes push people to leave, shrinking the tax base. However, pension obligations remain, increasing the burden on those who stay. This can accelerate during economic downturns. Additionally, New Jersey depends heavily on high-income earners and industries that can relocate quickly. If those jobs decline, tax revenues drop, and borrowing costs may rise due to credit pressure. At the household level, this feels like phantom inflation. Even with a fixed mortgage, property taxes, insurance, and local fees keep increasing. Over time, buyers may view the state as too expensive rather than desirable. What should you do? Homeowners should track property tax increases closely. Rising taxes can outweigh stable home values. If you're considering selling, earlier may be better in a high-tax environment. Public pension recipients should plan conservatively and prepare for possible adjustments. Diversify liquid assets across financial institutions to reduce risk exposure. Number 6. Kentucky. Kentucky illustrates how a financial crisis can build quietly. The state's public pension system carries a significant funding gap, yet many current and retired employees rely on it. When pension costs rise, the money must come from the same budget that funds schools, roads, and public safety, creating what's known as budget crowd-out. As pension contributions take up more of the general fund, the state loses flexibility. When a recession hits and revenues fall, Kentucky faces difficult choices: cut services, raise taxes, or restructure obligations. The situation is made worse by the state's reliance on federal funding. If federal support declines during a national downturn, Kentucky can be squeezed from both sides: lower revenue and less aid. This pressure eventually reaches homeowners. You may see higher property taxes, increased fees, reduced public services, and a slower housing market as buyers factor in total living costs. Infrastructure also suffers. Road repairs are delayed, schools face funding gaps, and local governments look for new revenue sources, often targeting property owners. What can you do? Public employees should treat pensions as potentially adjustable and build backup savings. Retirees should diversify income sources rather than rely on a single payment. Property owners should monitor local tax trends. If taxes rise faster than home values, it's a warning sign. Keep liquid savings diversified across institutions to reduce risk. Number 5. Connecticut. Connecticut has one of the most fragile fiscal structures in the U.S. due to its heavy obligations and narrow tax base. The state carries large unfunded liabilities, including pensions and retiree health care. A key vulnerability is its reliance on high-income taxpayers for a significant share of revenue. When even a small portion of this group relocates, the financial impact is immediate. This creates a cycle. To close budget gaps, the state raises taxes, which encourages more high earners to leave. As they exit, revenue declines further, deepening the problem. Over time, this leads to steady tax base erosion. The housing market reflects this pressure. In many areas, home values have remained relatively flat, while property taxes continue to rise. This is especially difficult for middle-class homeowners, who face increasing costs without seeing meaningful gains in property value. As a result, buyers become more cautious, focusing on affordability rather than appreciation, which reduces demand, particularly for older homes needing repairs. Connecticut's economy adds further risk. It depends heavily on industries like finance, insurance, and healthcare, all of which face potential disruption. If these sectors weaken, job security declines, and residents become less willing to tolerate higher taxes. What should you do? High-income earners should evaluate exposure to future tax increases and plan residency carefully. Homeowners should monitor demand and tax trends closely. Workers in key industries should prepare for structural changes. Those relying on public retirement benefits should plan conservatively and diversify assets. Number 4. Illinois. Illinois is a prime example of long-term fiscal stress that has been delayed but not solved. The state's pension system is among the weakest in the nation, with massive liabilities relative to its revenue base. Strong legal protections make it difficult to reduce promised benefits, forcing Illinois to fund obligations through higher taxes, service cuts, or borrowing. Population trends intensify the problem. As residents leave, the tax base shrinks, but pension obligations remain, creating a structural imbalance. This slow, tightening loop places repeated pressure on remaining homeowners, while demand weakens because buyers are wary of rising taxes. Chicago adds a second layer of risk. Weakening commercial real estate and permanently lower office usage reduce property values and local revenues. Since Chicago drives much of the state's economy, declines there ripple outward, pushing suburban areas to cover more costs through reassessments, fees, and political battles over budgets. High borrowing costs worsen the issue, diverting more budget toward interest payments rather than public services. Residents feel like they are paying more for less, which can accelerate migration out of the state. What should you do? Property owners should track taxes versus home values. Rising taxes with soft demand put equity at risk. Business owners should compare neighboring states for stability. Public pension beneficiaries should plan for potential restructuring. Young mobile residents should consider relocation as a financial strategy and safeguard against long-term fiscal uncertainty. Number 3. Hawaii. Hawaii's risk profile is unique but severe due to its isolation and reliance on tourism. When a recession hits, tourism often contracts first, and Hawaii's economy is not broadly diversified. Visitor spending supports jobs, small businesses, tax revenue, and much of the housing demand, particularly from second home buyers. The high cost of living intensifies the impact. Incomes fall or hours are reduced, and households feel the squeeze immediately. Leaving the islands is costly, so residents can become trapped in a high-expense environment during downturns. The state also carries significant long-term obligations, including pensions and retiree healthcare. These rely on strong investment returns, which may not materialize in a prolonged downturn. As a result, Hawaii faces the same difficult choices as other states: raise taxes, cut services, or reduce benefits. Hawaii's tax risk is amplified because high-income residents tend to leave entirely rather than partially commute. Once they depart, revenue drops and the effects multiply. More fees, higher utility costs, delayed infrastructure repairs, and fewer resources for public services. all of which make living costs even heavier. What should you do? Workers in tourism or hospitality should treat their jobs as recession-sensitive and build savings and a relocation plan in advance. Property owners should recognize that investment and vacation demand can freeze when travel declines. Public pension beneficiaries should plan conservatively. Anyone without substantial reserves should evaluate long-term options early, as waiting until a downturn can turn relocation or financial adjustments into a crisis. Number 2. California. California is often seen as too big to fail, but its size can actually amplify volatility. The state relies heavily on high-income taxpayers and capital gains, which fluctuate dramatically during downturns. When tech valuations or markets drop, tax revenue falls quickly, creating budget gaps even if the broader economy seems stable. Long-term obligations, including public retirement systems, remain enormous and depend on strong investment returns. In prolonged downturns, even well-funded systems can deteriorate, leading to higher contribution demands, pressure on local governments, and new fees or assessments on households. Deferred maintenance and infrastructure costs add another layer of risk. Tight budgets delay repairs, often creating larger emergency costs later. Population concentration also matters. California depends on a relatively small group of top earners for a large share of revenue. If that group shrinks or relocates, fiscal pressure rises rapidly. What should you do? High-income earners should plan for tax volatility and potential policy changes. Property owners in expensive markets should watch buyer demand and liquidity, as luxury markets rely on investor confidence. Public pension beneficiaries should not assume funded ratios guarantee payouts under extreme stress. Business owners should maintain flexibility, considering other states with lower taxes and growth potential as a hedge against prolonged slowdowns. California's fiscal system works well in boom years, but can tighten quickly when markets cool, especially given the concentrated nature of its tax base. Awareness and proactive planning are key to navigating these risks. Number 1. New York. New York's fiscal risk is highly concentrated because it depends heavily on one city, New York City, and one dominant industry, finance. High-income jobs in finance generate massive tax revenue, but automation, artificial intelligence, and structural changes threaten these positions. When these jobs disappear or relocate, the tax base shrinks sharply. Commercial real estate adds another vulnerability. Office vacancies reduce property tax revenue, yet obligations like transit systems, public services, debt service, pensions, and salaries remain. When two major revenue pillars weaken simultaneously, the state and city cannot adjust gradually. They respond with cuts, fee increases, and greater pressure on remaining taxpayers. New York is also near the practical ceiling for taxes. Raising taxes further can accelerate outward migration, which in turn shrinks the tax base and creates a feedback loop. Job losses reduce revenue, service cuts follow, quality of life declines, and more residents leave. Once residents perceive this trend as permanent, exits accelerate, making the loop self-reinforcing. What should you do? Finance workers should account for automation risk, diversify skills, and maintain mobility. Commercial property owners should be realistic about recovery timelines. Residential property owners should track demand, which depends on capital flows and confidence. Public pension beneficiaries should plan conservatively and diversify income sources. Business owners should consider states with growing populations and lower long-term fiscal burdens as operational stability becomes critical during downturns. New York demonstrates how concentrated revenue streams and high obligations can create rapid fiscal stress, and proactive planning is essential to mitigate personal and business risk.